Okay, let's kick it off and welcome again. This is Saxo's Outrageous Predictions 2023 webinar here in Asia. So we are very privileged today to have with us our Chief Investment Officer, Steen. He's been doing a world tour, presenting these outrageous predictions to a host of clients, to a host of our partners across the world. And, he's here. Just landed this morning in Singapore. So I think I would probably just extend a very warm welcome to him first. And then, of course, I would, Steen, love to hear from you, how the tour's been going, what kind of feedback you've been getting. Is it enough outrageous, not enough? What are you hearing?
Thank you, Sharu. It's always a pleasure being in Asia and certainly in Singapore specifically. The feedback for this year's race predictions has been very good. As always, people likes to be provoked into thinking differently. And for me personally, this is, I think, the 20th or 21st year of doing this exercise in December. Many moons ago, we started with five Danish journalists in a fish restaurant in central Copenhagen. And over the last 10 years, it's become a global endeavor, and it's a pleasure. I have to extend, a thank you to the team who's done a marvelous job of creating a great concept. I know you'll go into it briefly in a minute. And the biggest push so far in terms of interest is very interesting because we have this rule in our age predictions. The one that creates the most debate is normally the one that has the highest likelihood of actually coming through. And Sharu, your no meat one is the one that people want to talk about globally, and especially the males in the audience wants to know which country starts it so they can avoid to live in that country going forward. But I'm sure you're going to put on the map why this is not only a super interesting and necessary change, but also why it has created so much interest. For me personally, the war economy is about constraints, and constraints in themselves is really what we deal with today, because unlike what we've experienced over the last 25, 30 years, where we had infinite opportunities, either we could increase the amount of debt in society or we could lower interest rates, and there were no costs in terms of inflation. Of course, now all of that sits on its head. We have very high inflation. The discussion right now is between, reaching 2.5% next year, which most people seem to think. I may want to know what people are smoking if they think it's going to 2.5%, but we can discuss that later. And we, of course, have inability to deal with energy, which is very much the theme in our age prediction. So welcome, everybody. And I give the word back to you, to Sharu, to sort of outline the overall concept of this year's crop of outrageous predictions.
Thank you, Steen. So yes, I think that's been my experience as well. I mean, there's been great reception for this publication. This is my first year doing it, but a huge thanks goes to our global strats team, which has put an immense amount of efforts to bring about this publication. And as Steen mentioned, we've at Saxo done this for over 20 years, and the whole reason why this has been such a popular report is because, as you can understand, all kind of big market moves in every year would generally happen because of some unexpected events. You take the pandemic, or you take the war in Ukraine, most recently. So these were things that nobody really had in their forecast. So these are certainly a set of low probability events, but these will be high impact events if any of them were to happen. And it's outrageous. I know a lot of people have wondered as to when all the banks in the world are really coming out with what to expect in 2023. Why is Saxo not talking about that and instead talking about outrageous events which are unlikely to materialize? So I just want to again bring your focus back to the point that it is an exercise, obviously, to think, like Steen mentioned, but also to kind of analyze the risks in your portfolio if some outrageous events like these were to happen. These were some of our outrageous predictions for 2022, which actually came true. Fossil fuels will get a rain check. This was when we were still in the bull markets, and this was pre-Russian invasion as well. But we did talk about how the lack of a baseload energy supply could mean a shift back towards fossil fuels this year. Exactly how it panned out, and obviously the Russian invasion did accelerate that move, and that's why it happened right this year when we expected it to. But it's also, I think, realizing the vulnerabilities of the system is what we are trying to do here. Similarly, the Facebook one here, where we had this call on broadly the platform companies that they could get into trouble, and we talked about Facebook in particular. Recognizing that younger generation does not really want to engage as much with Facebook or Meta as it is called now. So overall, while these are outrageous, there is some amount of seriousness behind it. There is some impact to be considered, and you should probably consider these as a risk to your portfolios. Coming back to what we have for this year, the theme around the set of predictions that we have this year is the war economy, as we call it. It's a great title. I think it's come from one of our colleagues in Copenhagen, and this is not just referring to military conflict. It is it is more of that deglobalization and the polarization story that we have seen for a good part of this year, and we think it will take a step further into the next year as well, and across a variety of aspects. So you started with the pandemic, where you realize how vulnerable, how fragile our supply chains were. So because of that, the economies had to come on a war footing, where they could not really source their key components or their key resources, food, agricultural products, and at the same time, you had fiscal and monetary policy excesses kind of further boosting demand, which again pressured supply chains, people working from home, not going out and being as productive a part of the economy as they would be on average. So all of that has obviously made a lot of economies realize the importance of reshoring, and the supply chains are in a flux. So I think that will be a key theme going into next year. Of course, military conflict, the Russia-Ukraine situation, has had a lot of impact as well, where countries don't want to rely on a complex set of supply chains or many other countries to get their resources. The dependence of the EU on Russian gas has obviously exposed that phenomena very well. So I think again, obviously, the military conflict is part to play, or geopolitical tensions will also have a part to play. Focus shifting a lot more probably towards Asia as well into 2023, where you have the Taiwan situation playing out, and the chip situation playing out. And do you want to still kind of continue to importing your chips from Taiwan, and be exposed to that risk going forward? So I think that will be a key component of this war economy taking place even in Asia into the next year. We talk about energy infrastructure, where again we continue to realize the vulnerability because of the lack of a baseload supply. So just as soon as this week, we've had these fears coming out from the UK, where, of course, they are now facing a very harsh winter, and the wind is not blowing. So that has prompted another leg of volatility in natural gas prices as well. They are drawing further on their gas reserves. We can all, obviously, focus on going green, return to ESG expectations, but when you don't have the basic infrastructure to support the baseload demand for energy, to heat your homes, to run your industrial setups, the economies will then in that case remain on a war footing as well, to ensure they have a reliable energy supply as well. And then when you talk about financial insecurity here, that also exposes the financial polarization that we are seeing because of excessive dependence on USD, and then with the war from Russia and its reserves being frozen, it was obviously a panic situation for Russia, but it was also an alarm for China and some of the other countries who are excessively obviously dependent on USD and reserves. So there's a greater need to find neutral ground there. So we are also talking in our individual outrageous predictions, which we will get to very soon now, about the need for being less and less dependent on USD and being a lot more independent or polarized, so to say. Again, climate change imperatives will also take a bigger focus again next year after being sidelined for most part of this year, which will again drive changes, drive economies to explore ideas that could benefit their own ESG targets, their own net neutral targets, kind of things, instead of really believing in the globalization phenomena that has been there for a long, long time. Well, the common theme around all of these ideas will remain inflationary. I think that, so all reads all of the roads are currently leading to inflation. If you consider supply chains getting reshored out of China, you consider the green transformation that we have in force, which again leads to higher energy costs as well. If you consider, even the most recent events of, China reopening its economy, which will mean that they will need a fresh supply of commodities, a fresh supply of energy and industrial metals, so to kind of meet that need. So again, we see another run higher in commodity prices as well, higher military spending to be after the awakening that we've had from this, again, Russia's invasion of Ukraine, will also, all of these factors will possibly continue to drive inflation structurally higher for years to come, despite that softer CPI print we've had last night from the US. It does not mean anything in the long scheme of things. But like Steen obviously mentioned, that long-term inflation expectations are normalizing. So we are very different from market expectations on that front. We do think that these will need to be revised higher again into the next year. So the war economy as a whole may not be that outrageous a theme. It's a part of our baseline theme, but some of the predictions inside are, as a product of these war economy, are outrageous, and we would hope they would remain outrageous. But maybe I will just take a brief pause here, and Steen, back to you, if you want to add more on what this war economy theme is all about, and also probably kick off with the discussion around some of the themes there.
Really don't have a lot to add except that maybe just a brief conversation about the major call for next year, of course, for investor will be whether there will be a recession or not. Now, having a few years under the hood in terms of doing this job, if there was a recession next year, it will be, number one, the most pre-announced recession in history. But more importantly, it will be the oddest recession that I've ever seen, because the starting point here is that due to the COVID pandemic, we have the highest level as a starting point in terms of cash reserves in companies and in private sectors. We had the single biggest transfer of income from the public sector to the private sector during COVID. And we have the loosest monetary policy in history by at least 9 standard deviations. As we talk today, we have full employment in the US. High frequency data for the US for Q4 is indicating that US growth will sit somewhere in a wide range between 3 and 4%. Financial conditions after yesterday is now easier than when we started hiking interest rates in increment of 75 basis points, which in itself indicate that inflation will be coming higher. And finally, there is an old rule of thumb as an economist that wages is the ceiling of the inflation overall. So of course, with wages in the US and globally running at minimum 5%, it's kind of interesting that the 2, 5, 10 and 30-year break-evens indicates a 250 interest rates, whatever happens in the world. There is a market for trading actual fixed income 12 months out. It's trading at 275. Against this sits the 5% wages, and of course the energy which everything being equal to me is and never was about this winter, but next winter. So in other words, it's not going to feel like, it's not going to smell like, it's not going to be working like a classic recession. And the reason for that, of course, is that when you have a run rate on inflation of 7%, the nominal GDP will grow by minimum that 7%. So you may have real rates negative, but you have a net growth driver, both for equities, for you as a consumer and everybody else. So the concept of recession needs to be qualified if we need to go to that.
And
You
great. I
want
think
to
that has
start on
obviously
the
been,
outrageous?
yeah, yeah, I think that has been one question on top of mind for everyone. So that's good you answered it up front before we got to the questions. But yeah, I think maybe we could jump back into the outrageous predictions. We have the slides coming up again. So, Steen, do you want to take the first few there?
Sure. It's actually a favorite of mine. Because if you think about the question just discussed, recession and inflation, it really depends on energy. I think what we learned from the Ukraine war breaking out and ultimately the supply chains disruptions we have from COVID and Ukraine, it's pretty clear that in particularly Europe, but also Asia, is not yet prepared to actually both source energy in a safe way, but also making sure that this handover from the fossil energy sector to the renewable and alternative energy overall is not ready. It's a great vision. It's a great challenge for society. But for this winter, we all were okay. Partly because China didn't show up as a net buyer, partly because Europe was able to get a lot of LNG being shipped in from the US. If we look forward to next winter, that is not going to be a solution. Into this place, this what we call the Manhattan Project of Energy, and it actually has two iterations that is important. Number one is, of course, that the big platform, the FANG companies, has created a huge amount of wealth for them, for the management, but also from from the employees. So they sit on a huge amount of profit to deal with. And if you think about these platform companies, they have two incoming risks to their business model. One is that they so far have been treated on a regulatory relatively lightly, despite the fact a lot of them actually run as monopolies. Certainly, Microsoft is an example of a total monopoly and no monopoly regulation being enforced on them. Secondarily, these companies, of course, are all digitized. And as the economy is trying to digitize itself, it creates a vast amount of data. Data storage is growing exponentially. As it grows exponentially, of course, data center is at risk. And these data centers, we estimate, could be taking up to 20% of the overall electricity consumption in the world as we go forward. So these company has a choice of being part of the solution or being part of the problem. If they don't address and if they don't step up in terms of actually creating, the huge fund of private capital that works with these alternative energy sources, we think it's very likely they either get higher regulatory thresholds or they will simply be, reducing their ability to access a public generated energy system in itself. Next to that is the fact that over the course of this week, we've seen fusion energy reaching new heights. Of course, we are still somewhere between 0 and 10 years away from getting a lab experiment into the practical world. But both hydrogen and other reactors right now is coming online. What this projects, all of them needs, it's a huge amount of capital. So to this extent, we think, a billionaire coalition funding a private endeavor, making sure that research goes into energy, similar to the Manhattan Project, and then solving for the number one issue in society is one of the calls we want to make. Maybe it's not 23, maybe it's 24, 25, maybe it's over the next 10 years. But it is absolutely certain, at least to me, that this number one call is what's needed. We need a private public partnership on basic research. We need to stop pretending that renewable energy is the solution. It is part of the solution, but it's not the solution. And as such, these companies sit very central, both because they have the assets, but also because they have the biggest issue going forward in terms of positioning. The second one is there's a saying in France pretty much that who cares what happens in France, but that is not only unfair but is also unreasonable because Macron and President Macron represents the European spirit, the European ability to renew itself and moving on the agenda. What is interesting here is that very unprecedented to a large extent. Uh, Mr. Macron won the presidential election. What normally then happens is that you have a parliamentary election that normally supports the same president and gives in a majority. So, in other words, you have the ability as president in France in normal circumstances to not only, of course, be president, but also run the parliamentary session in terms of budget and domestic policies. This is not the case with the present president. He actually lost outright the parliamentary election. And as such, he is reduced to a large extent by executing foreign policy and then using the decree, which you mentioned in the text, the Constitutional 49, Section 3, where he can actually overrule the parliamentary majority, whatever they think, he can rule by decree. He did that for the budget, and he's done it. And take note of this: 7 times so far in this session. 7 times he has actually uh, been in opposition to the majority of the people's vote. That is unsustainable. If you look at the European map and the French politics in particular, the narrative and the political activism is driven by the far left and the far right. So what we are saying is that maybe what needs to happen is actually that Macron one day wakes up and smells a coffee and say, listen, I'm a lame duck. I want to move the agenda both in France and Europe forward, but I'm not able to do that on a domestic agenda in France. And as such, I'm a little bit impotent in terms of my foreign policy ability to create a movement in Europe to move towards a more unified Europe. What I will do is instead, I will do similar to what General Charles de Gaulle did in the 1950s and 60s. I will step back from politics and let the far right and the far left fight it out. When there is enough turmoil, I may return to the scene, similar to what de Gaulle did the second time, and sort of be the savior, and then moving French politics to the center and not to the peripheral and strong-worded nationalism that sits on the far left and far right. And make no mistakes, Europe at large is really driven by the far left and the far right. The middle positioning has disappeared over the course of the last 4 to 5 years as we move into COVID, where the government stepped in with a heavy hand, and also due to the fact that the disenchantment with politics at large, of course, which what we saw in the Brexit and Trump being reelected, and a number in Italy, we saw a very far right president being elected. So this is the landscape not only in Europe but also in the US, that we have no middle, a very very strong, opinionated, often totally on. Rooted opinion about politics sitting in the far left, far right. What we need here is that there is a clean out and an ability of politicians to actually step down in order potentially to come back. This would create enormous amount of uncertainty for Europe and of course for France, but we think it's needed to create the mandate for change for both France and Europe. Over to you.
Thank you, Steen. Okay, let's jump on to the next one. Before we do that, I think I would just remind you also to post any questions that you may have in the Q&A box. I think it should be on the top right of your screens. We already have a couple coming in, but yeah, I think, and of course, Steen has already answered the big one on everyone's mind about recession. So, but I'm sure there's a lot of other things that we probably want to discuss here beyond these outrageous predictions as well. So please feel free to pop in those questions there. Okay, the next one here about gold rising to $3,000. I think again also getting a lot of attention globally, and it is like it is just an extension, I would say, of the central view as well for most of the central banks. So just the level is, of course, a little bit more outrageous than what most others are predicting. But why we think this is the case really is that, 2022 has been a challenging year for gold, especially if you look at it in terms of the US dollar. And, despite that inflation running to 40-year highs or so. It was obviously expected that gold could do better in such an environment, but there are other things that played a part here. There was the US dollar, which rose about 8% or so. Real yields rose 2.5% or so as well. But still, I mean, despite those factors, I think gold has been overall quite stable if you look at it from a US dollar perspective, and has actually done better in other currencies. So, it turns out that the reason why gold did not do as well as it does in an inflationary environment was because the market continues to bet on the fact that inflation will still prove transitory after a year of realizing the kind of inflationary environment that we are in. Central banks would largely anticipate that inflation will fall back to target within merely like a year or two. By 2024 and we are seeing market pricing inflation to go back to around 2.5% levels. So I think that has been really the factor why gold did not see the benefits that it could see for most part of this year. um, However, we do think that next year this faith will get shaken. If you think that the dollar could find a peak and the war economy footing could bring inflation to levels that the markets are not pricing in right now, central banks will not be able to hike rates to a level above the inflation. So they have obviously massive debt loads, they have interest rate payment pressures as well. So it will be very hard to bring real yields back to the positive territory. And any drop in real rate expectations would potentially weaken the US dollar. So overall, I think that realization would set in into 2023, where markets start to understand that policy rate will remain below inflation for the longer term. And of course, there's the other aspect of it in terms of the geopolitics. We've already seen last week the Chinese central bank starting to add on to its gold reserves in an effort to minimize or move away from its dollar-based holdings as well. Of course, there are a number of countries who want to do that beyond Russia, beyond China. So I think that is obviously another supportive factor, and that's been one factor over this year also why we have actually seen gold a lot more stable. But when these real yields stop rising, the overall backdrop, along with this central bank buying behavior, will turn a lot more favorable. And with also, I think the third aspect here potentially would be the Chinese demand picking up as well with the reopening of the economy. So all of the factors, and when I think continue to point towards a better demand for gold next year, and that's the reason I think we came up with this one. I think the real yield story here is really interesting. And I think we'll just move on to the next one. I think a colleague from Hong Kong, Redmond, would take that up.
Yeah, thank you, Charo. And yes, and I think this, the next one is the foundation of the EU armed forces, and that is. I mean, that's basically because of three things that changes. And number one, I mean, in the past until recently, and I think the European think that there will be no war in Europe, and that definitely has changed. And the second thing is the European has not been spending in the defenses, because that's basically under the protection of the U.S. and under the NATO, and also overall is relying on the U.S. defense protection umbrella, and that's changed. And number three, and that is if in case anything happened in Europe, and because it's still very important to the U.S. and is expecting the U.S. the focus will be in Europe, and they will come to the rescue. That's to a certain extent that's also changed. Let's dig into the more detail. And I mean, as we all know, and since earlier this year, we have the Ukraine war, and the Russian remain the Ukraine. And that, of course, that is really the first very large-scale hot war in Europe, and for a long time, and that is a wake-up call to the European. And until that moment, I mean, the European basically thinking is a full international trade, interdependence, and getting the Russians is more and more actually through it's importing resources, energies from Russia, and then Russia become more prosperous, and there will be no war. And also through the EU effort and all the European countries themselves being sort of united among themselves, and there will be also getting more and more integrated, free movement of goods and services, free movement of capital, free movement of people, and there will be that it's no war in Europe. And of course, that's been changed. And the second thing we talk about, actually you look at the that chart is.
Brendan, maybe you can also maximize the slide so that our viewers can see it more clearly.
I think I have already maximized it, but just let me. You are not seeing that on the maximize from it?
No, yeah, it's okay. Just go ahead. I think it's still visible. Yeah.
Yeah. Okay. Is you can look at the chart on the right hand side. You see the European military spending has been declining to below 2%, and in fact in Europe, and it's only France has ever close to the 2% level is targeted by the NATO. NATO actually recommended 2% across the board target, and the others will be the European countries, Eastern European country. If you count the UK as still part of Europe, I mean, that would be the UK is also spending more than 2%. But I mean, given what's going on in Ukraine, and I think the European countries now need to spend more of that, and then they need to boost their military forces. And then so far they have been behind under the umbrella of the US. But two important development recently, I mean, in the recent years. Number one is the politics in the US is actually moving more and more, especially after Trump, and that actually have an alarm bell to the European, and then the US foreign policy can become more inward looking. And also is the shift of focus getting more and more to Asia Pacific, and because it's actually with the tension with China, and so the US is actually moving its focus to Asia Pacific. So for that, the European really have to build their own defense force, and it's very sensitive, of course, to an individual country, European country, to build up their own military strength. And given what happened the last two World War, and also it will be very sensitive for the German to build up their own. But so that is more, so that is one of the compromise. Probably the direction will be, we think, and that will be a EU armed force joining, and so the command will be joined by the EU, and that will be the directions, and to build up the defense again for the securities of the European country. And so I think, I mean, that would be a long project and will require a lot of money, and that probably will be for the next 20 years to build it up. But that would be so I think we get to the next. I think the European need to find a way to raise more revenue to do that. Yeah, I think I'll pass it back to you.
Okay, thank you, Redmond. So yeah, let's jump on to the next one. The one that Steen mentioned has been getting the most attention, and we love that. Is a country agrees to ban all meat production by 2030. So this argument really is, it goes beyond the health benefits and or even the ideas of animal welfare. I think the key reasons why we considered having this as a part of our publication this time was uh, I think I would highlight two key reasons there. One, of course, is the hunger crisis. Loads of grains are being used to feed animals that are reared instead of really feeding the populations of the poor countries where hunger is becoming more and more rampant. But a bigger reason really here is carbon emissions. So the two activities that generate the highest amount of carbon emissions really are air travel and meat consumption. Why meat consumption? I think that comes as a bit of a shock for many of the people that we speak with, and that's because meat consumption needs to you need to cut down a lot of the forests that obviously for the grazing of the animals, and a large amount of pesticides are also used, which of course have nitrogen. So as you can see here on this chart, some of the meats, the red meat obviously is contributing in a big way to climate change, and that's primarily because of the land use that you are engaging in, but at the same time, of course, you are contributing to a bigger hunger crisis as well. But why we think this will get a bigger focus now is because of those ESG targets, and many countries are far away from their net zero targets, and given that we've talked about in terms of the base load requirements for energy will mean that the complete turn towards ESG will still remain elusive. So we are arguing that cutting or banning meat consumption may be used as one of the tools to reach that target, closer to that target at least. And again, who will do it? Essentially, given that the energy pressure is the highest in Europe, the ESG commitments are the highest in Europe, it's possible that we see the first step coming from there. On the left here, these three pie charts have highlighted a survey where people actually believe that people in France actually believe that changes in individual behavior can bring about changes in climate, and they're also more acceptable to government interventions as well. So, of course, again, that increases the conviction that it could be seen in Europe. And also from that net zero perspective that I just mentioned, the chart on the right shows that, if you look at the countries that have binding net zero commitments, legally binding net zero commitments coming up sooner rather than later. So, in the text, if you go through that, I've highlighted Sweden, where the net zero target is actually legally binding, and it's 2045. So it's 5 years earlier than UK or France or Spain. So I think it could be considering that, or the Netherlands, or down at the bottom of that chart, where the targets are more steep, so they're further away from the target than most of the other countries, although the targets for 2050, but they're way behind on their targets as well. So I mean, these are just some ideas or options of countries that they could consider, but you could see a surprise move by any of the other countries. I mean, maybe not a complete ban, perhaps higher taxes on meat or something like that. But we do think it will be one of the steps in the years to come to really get to your net zero commitments. Back to you, Redmond, on the next one.
Hi. The next one is UK holds a unvisited referendum, and I mean, it's the thing is that the theme is the deglobalization. I mean, it's and initially when the UK left the EU, and under the notion that the world is still is in the peak of the globalization. So the UK can secure all the other free trade agreement and all kind of economic cooperation agreement freely with all the other individual countries. And now, and the world is moving to more deglobalization. Is those effort to build country-to-country trade union or free trade agreement become more and more difficult. And then the second thing is that the British now has been experiencing quite a lot of suffering from the Brexit red tape. And actually, you can see here, 33% of those UK exporters to EU, they just left the UK. And so because there's too much hassle, and after the Brexit, and there's so much red tape in trade from selling things from the UK to the EU. And also in terms of people, and a lot of, say, thousands of those EU doctors, and they have been very important to the UK health system, and they left the country. And the third thing, that I think the opinion has changed as well. And because of, you look at the right-hand side, the chart, the polling showing that is now more than 50% of those who participate in the poll said it's wrong to leave the EU for the UK. And if you look at the left-hand side at the bottom, you can see at the time when the referendum in the UK, the Brexit referendum, and there's a very big, very clear distinction between the younger generation and the elder generation. And the younger generation, they are much more in favor of staying and remaining in the EU, while the elder generations are more of them voted leaving the EU. And of course, as time passed, and the elder generations is more or less and less important in the economy. They have left the working force, and the younger generation are actually the backbone of the economy, and that also shift the dynamic of the whether the UK should be part of the EU questions. So as I get given what's the fiasco we saw back in October when the Tusk government tried to do the supply side tax cut, at the same time doing a lot of subsidies for to energy users in the UK, and that is basically is crystallized and make it more apparent that is the UK is the economy was in this kind of difficult twin deficit situation with a big hole in the fiscal balance, and at the same time running a very large current account deficits that need to be financed by capital inflow. And so all these come together that has make the decisions of leaving the EU become more questionable. And given the austerity now and in the UK, and the UK is very likely to run into a recession in 2023, and maybe a quite severe one, and that will make the Tory party's popularity become very low, historical low. And then the Labour and the Liberal and they will the agenda will be more back to the table again to rejoin the EU. And so it's a scenario that is probably Tory will lose in the national election, and the new government, probably a Labour government, and will fulfill the election pledge and to hold a unvisited referendum for the UK to join the EU again. So that is our one of our predictions. I pass it back to you.
Thank you, Redmond. And Steen, maybe this is your brainchild and something you've been talking about for many, many months, widespread price controls. Perhaps you want to take that.
Sure. Of course, part of the story has already happened. In the case of France, we have, the French government willing to actually let the French utilities go bankrupt in order to secure that the pain on the consumer remains sealed off by a price cap. And if you go back in history, there's a long line of, especially in war economies, but also in societies that is under attack, that the government steps in and are the famous words which President Ronald Reagan in the past said was the worst words in the vocabulary. We are the government. We're here to help. And of course, the concept here is that if prices are not able to mean revert or come down as consensus indicate right now, and if they remain elevated, then the politician in particular will want to control the impact on their voters, and through the voters, of course, the disposable income. During the 1960s and 70s in the UK, where you have massive inflation, massive unemployment, and massive devaluations, they introduced a pricing board, similar in the US after World War II. So this goes to our theme of war economies and the fact that we run under and operate under a very, very constrained economy. We have, for the past 2 years, constantly been telling people that the real economy is too small for the combination of fiscal, monetary, and green aspiration. We think that came to fruition. We also know now that in the case of the US, 90% of all asset trade in the US is intangible, so basically IP, whereas the real economy, the tangible assets, the one that has to deliver on all the promises and all of the websites that promise to give you manna from heaven if you buy this and that product. That is not feasible simply because the supply side remains extremely low relatively to the excess demand that still exists to this day. In the case of the UK, of course, we saw that Liz Truss, the former prime minister, only staying for 42 days, mind you, but she managed to promise everybody that the maximum pain on the UK households will be limited. She's now replaced by the former chancellor, the same chancellor that actually created a huge amount of the fiscal deficit that runs in the UK. The side story of this is that since the emperors before the birth of Christ, basically every time there is a crisis in society, when prices run wild, when we have warlike economics, we will see the government hand get heavier and heavier. They feel obliged to actually control and manage the prices because wrongly they assume that they can control the impact on the economy. What of course actually happens is that the demand remains elevated and the investment into alternatives gets subdued by the mere fact that there is on the demand side a constant support and subsidy paid by society into this, making sure that we continue to use and utilize a model where we are effectively having a negative return on invested capital, not dissimilar to what we have today, because as of today and as of the last 20 years, pretty much, we have been running negative real rates, and negative real rates at the end of the day means that we have no productivity. So expect at a bare minimum in 2023 and 24 that the government hand will be heavier. And if prices do not, as consensus dictate, comes down, then you can expect government to step up with price boards and price control at large, because that is historically what they will do. And they feel they're here to help, not to destroy. The only thing they will do is delay the inevitable, which is that we need to move society towards productivity.
I thank you, Steen. And the next outrageous prediction is OPEC Plus and India walk out of the IMF and agree to trade with a new reserve asset. And India's, of course, is the China and India coming together. And until now, after the Second World War, and the whole world is relying on the US dollar. And so it's as the main, the dominant reserve asset, and also as the unit for settling international trade, invoicing, settling, and payment, and so on. And number one, of course, because of the US has the biggest military force, and that make it the US dollar considered as safe, and also have the power to tax and on this large economy, the world's largest economy, and then it's also the US dollar has a very deep capital market, and you can finance and you can keep your wealth there. So that has been the case and all the time until now. But a few things I think is asked and let all the countries now start questioning whether that's a good idea. And number one, and we have been seeing inflation picking up in the US. And in fact, it's holding on to US dollar, and it's many of those countries that they will be losing in purchasing power and over time. And also historically had also been the return on investment in the US has been lower than the other way around when the American invested overseas. So that would be one thing. And the second thing, is we can imagine what the Crown Prince in Saudi Arabia or presidency in China, and all they will think when they see the U.S. Treasury just impose an order and then basically can freeze the assets of Russia central bank, and the U.S. Treasury has this kind of sanction power for quite some time, has been using it in anti-terrorism, but usually it's very much smaller scale. And the extent and scope of it is much smaller. And this time it's much bigger scope, and that actually did ring alarm bell among many capitals and across the world. And we have been seeing some of those efforts already. It's now you have been seeing India using rupee to buy oil from Russia, and also China has signed a lot for currency swap contract with agreement with many countries, and also encouraging to use the renminbi in settling international trade. And last week, Xi Jinping actually was in Saudi Arabia, attend the China Gulf Country Committee Council, Gulf Country Council's summit. And during the summit, actually, President Xi call on the GCC country to use the renminbi to settle oil and gas, and while China pledged to import more oil from the Middle East. And but of course, I'm not sure whether the feedback and the difficulty will be choosing either the Indian rupee or the renminbi, that you will be shifting from another hegemon from the US to another one, to a new one. And because the difficulty is the thing, I think many countries think that they don't want to have one country to have the knowledge or the right to print money, to use the printing machine to print money, and all the others will have to basically keep their wealth in that money. It's only that particular country can print, and then subject to the fluctuation of that country's economy, their policy, and also other political considerations. So, and moving to China, moving to use renminbi or the rupee will not be such a good idea. For example, using renminbi will not be such a good idea for the Indian from their point of view, and vice versa. And for the Saudi also, probably they would like to have some other alternative. And the other alternative in our opinion can be this country can go back to the playbook of the British economist John Maynard Keynes. And after the Second World War, and before the founding establishment of the IMF, John Maynard Keynes actually proposed a new international trade settlement system using an international clearing unit, and then all the countries and through that international clearing unit ICU, and they can clear the trade among those countries and the differences in the trade balances. And then we use create a new currency, a new unit of accounting, and that can be used as a foreign reserve as well, and what they call at that time it's called bank call. And so we think that for OPEC plus, and also many of those resource-rich country exporters, together with some of the major importers of those resources like India and China, and will come together. And in Kazakhstan, in Central Asia, and in the conference, they will agree on go back and create a bank call and also an international clearing unit. And the idea how it works, and basically the bank call, it will be backed by a basket of those tradable commodities, and then it's basically a currency among central banks, and then it's a unit for this all the country to settle the differences in international trade payment, and then the value of the bank call versus individual currency will be adjusted in accordance with the differences and the changes in the trade balances of individual country. And so that will, of course, the market impact will be I think that would be negative for the dollar, and obviously, and that would be we're calling for a 20-25% depreciation of the dollar against many of those currencies, many of the currencies of many of those countries who take part in this bank call project. And then another market would be badly affected would be the U.S. Treasury securities market, and because when everybody using the dollar as the reserve currency, and they have to park their wealth and in the U.S. Treasury market, and now when this country moves to a new settlement system, new reserve asset, and the demand for U.S. Treasury will be much smaller. And this happened, of course, is when at the time if the Fed is actually we need to reduce the balance sheet, so that will create there will be a quite a lack of buyers and buyer strike in the U.S. Treasury market, and that create a massive selling pressure in the U.S. Treasury market and push up Treasury yield. And that is our outrageous prediction. And Charles, I'll move it. I pass it back to you.
Right. I think I'll be just a bit quicker now because we want to get to some questions as well. We're running short of time. So I think this one on USD yen being fixed at 200. So, of course, yen has snapped back strongly recently because of the lower US yields. But given the entire thesis that we've put together about higher inflation, that does mean that US yields could run higher again significantly next year. And right now, what we have really is a simple belief that inflation will normalize and yields will normalize, and Japan will get away with this entire pressure without really any major shifts in its policy, and everything will be okay. But our risk to that scenario is, as we've highlighted earlier, is that yields continue to run significantly higher, and to respond to that, the financial system in Japan will need to get its act together, else all of the pain still just flows through the Japanese yen as well. And this year, of course, has been a good reflection of that. We had USD yen going up to 150 kind of levels, and it was a huge cost. It was a huge cost because about 18% of the reserves had to be used to defend the currency in a very short span of time, a matter of a few months, really. So unless, of course, Japan wants to kind of completely blow off all of its reserves, it will have to adjust its monetary policy in a big way eventually. But to get to that, I think once you see USD yen potentially blowing past 160, 170 levels, you have this soaring inflation concerns, public outcry over it, and that does swing the government and central bank into action. So that's one thing we are watching for as well. But I'll just stop here and pass it back to you for the next one, Redmond, and the last one from our side today.
Yes, thank you, Charlie. And yes, and the last one is the tax haven ban kills private equity. And I think it's with this war economy, and as we discussed earlier, it's the governments, is especially in the European governments, are really in need of generating more new sources of revenue. And one of the low hanging fruit would be those tax avoidance through using those tax haven jurisdiction, like in the Caribbean, like Cayman, and so on. And so private equities and also in hedge fund and so on, they actually park quite a bit of they set up their funds in those different country and use a complicated feeder structures, and that is make some of those investors investing through those funds will be can avoid some of the taxes. And also in the case in the US, I mean, is the carry interest is taxed as a capital gain. There are lower tax rate than income tax, and carry interest is those are floating profits, and when you make an investment over the long term in those private equity fund, and so it's those are partners unrealized earnings inside those private equities. So those governments will be, especially EU government, will be willing to get onto those Caribbean countries to ask for more transparency and sharing of information. And you can actually from this chart, from this page on the left hand side, on the you can see all those red square and representing those jurisdictions not cooperating with the EU in good tax governance. Many of them are in the Pacific and also in the Caribbean, in the Caribbeans. So I think that will of course is make it less desirable for those vehicles, and that will make the private equity firm more difficult to source investor fund and to put into this private equities fund. And that with the market impact, and that will of course those private equity, the share price of those private equity firms themselves will be pressured, will be probably will sold off, and valuation will be lower, and also there will be less M&A activities, and also will be less liquidities in the M&A market globally. So that will also be a negative for valuations in private enterprises and so on. So I think I'll stop here, pass it back to you, and maybe open for questions.
Yeah, I think that's all from us today. I hope you enjoyed this presentation. I mean, you can access the PDF write-up for the entire outrageous predictions for 2023. I've attached this to this call as well, so you should be able to find it somewhere on your screens. But if not, of course, it's available on our platform and our website as well. So feel free to read that in more details at your leisure. We can get to a couple of questions, maybe. There's one on the housing market. Will the housing market go down in a big way, Steve? Of course, we've had a lot of discussion in this internally, and your strong views have been extremely relevant. And I think it's a value add compared to what we read generally in the floating around from different investment banks and in the market usually. So maybe it's a good time to discuss that as well with our viewers.
Not necessarily it's a strong view. I'm just pointing out the fact that when the market is down 10 to 20% after a 400% rise, it doesn't constitute a housing crisis in itself. It constitutes a slowdown of the momentum of investment into housing. And of course, commercial real estate is really driven by the total amount of intake from rent, and rent classically is aligned to the interest rates, and only if the rents are renegotiated does it have an equity impact on commercial real estate. So, most companies, at least in the US and in Europe, have moved over the course of this huge monetary stimulus to fixed rates. There's a few geographic jurisdictions in the world that have a mix between floating and and fixed, but in essentially it's a fixed model which revolves and is renewed every 18 to 24 months. So whereas the 2008, 2009, of course, became a massive housing crisis, that was really more to do with the origination of mortgage payments and mortgages in itself than it was about the overall state of the market. Clearly, the market has been and remains frothy, but the good real estate is going to do well. And net, if you look over the last 30, 40, 50 years, REITs as an investment has been only beaten by equity net and only really growth stock over the course of that period. So for me, it is still a stable part of the portfolio. Is there a need to reprice? Absolutely. But in terms of it collapsing, it will no. Simply because the nominal interest rates, the nominal growth will continue to be just 7 to 8%. And the migration you see in particularly in Asia and in, for Singapore and some places in the Middle East as well, you see a huge amount of migration based on, escape from political regimes, but also tax and cost weather related. So for the major cities, I do not expect this to be a major issue. Specifically for Australia, there may be a little bit of an issue, but not this year, but next year and only in the second part of it. And I will be very surprised if the government didn't step in or the central bank didn't step in to alleviate some of the pain. So you can say even if I'm totally dead wrong on this, you will see government intervention globally on real estate, which means that there is, after this rough is taking out the market, a stable return in housing. But I have to say as well, as you indicate, Xiaoro, all the young people on the team thinks that real estate is going to collapse and it's going to be a major issue. And I still need you guys to prove to me why that would happen. But that's a different story, and it only makes a market, obviously.
Thank you, Steen. We'll try harder, but it's easier to buy your views first. It makes a whole lot of sense, though. So the other question we have is, will gold and silver go up significantly? So I think I did lay out the grounds for why we are, of course, bullish on gold going into the next year, and that's because eventually markets will come to realize that central banks cannot raise rates above the level of inflation that we still have. So I think with that in mind, I think I will just probably focus a little bit more on silver here, which is of course even more interesting than gold because it has actually one eye on copper or on industrial metals as well. So half precious, half industrial, and that makes it all the more interesting with this China reopening story playing out really well. We've seen, of course, a lot of efforts in that direction from China to move away from their zero COVID policies. While of course this won't be a one-way street, and we will continue to see some headwinds to that. With the rising number of cases and people staying off work because they're calling in sick and the likes. But I think at this stage, I would not really doubt the intent of the authorities to open up and ease restrictions. And also, I think the property sector, so because Chinese growth has been slowing, the export leg, which was the key driver of Chinese growth over the pandemic years, is also weakening because of the pressures on global demand. They have to shift to focus a lot more on consumption. So I think, of course, those zero COVID policies, but also stimulus measures to, support the property sector will kind of continue, and that obviously supports the demand for copper, which also has supply side issues. But okay, I'm not getting into copper here, but with that kind of scenario for copper and for industrial metals in general as well, I think that is another supportive leg for silver beyond the aspects of real yield and inflation story that we still have in place for next year. So yes, I mean, beyond these outrageous predictions as well, I think we are in the bullish camp, and gold has actually broken a key resistance level last night, 1808. It's now trading around 1809, pretty stable in the Asian session, but I think it does open a lot more room to go up higher as those key resistance levels have been cleared. And same for silver. I think 23.55 was the key resistance that it was trying to break above, and last night it has broken above that level. I did touch upon China briefly in my comment here, but certainly Redmond is the China market expert, and we have a question there. What do you think about the China market? Let's take that as the last one, Redmond.
Yes, I think I think it's the reopening is actually faster than we have expected, but we have been also expecting actually they will be relaxing some of those practices. And so that's not completely a surprise to us. And just the speed is actually quite fast. And then, but what we want to focus on more on the macro backdrop is we have been arguing that is the credit impulse in the Chinese economy has already been picking up, so has already bottomed, and actually pointing to, with that 11 to 12 month time lag, and it's actually pointing to a rather strong recovery towards the summer next year, or second or third quarter next year. So as the stock market usually, will not wait. So we'll be seeing actually there will be some support not only for the reopening story, but also for the credit impulse. And the risk, of course, is more on the regulatory side. We don't see any changes in the Chinese government's attitude towards, say, the private enterprise, the difference between private enterprise and the state-owned enterprises, and also on the tech industries, the anti-monopoly stance. So there will be still some risk that there will be some favor the stop and go traffic, like kind of if to prevent the private enterprises and the mega cap tech company become too strong. So those still be a little risk. And other than that, the overall economy probably is gaining back on its feet.
Okay. Right. I think we're well past the time that was allotted to this presentation today, but thank you all for joining us. We really hope you enjoyed it and provoked some thought processes behind, what we are thinking and what could potentially happen. Do consider the risk in your portfolios, and I think we look forward to having you on our future webinars as well. Thank you. Good day, everyone.